Hello everyone, welcome back to the part 2 of Introduction to Accounting. This is going to be most important aspect of accounting where you're going to see various type of accounting as well as. So last class or the last session or the last video we have seen what is accounting, the characteristics and the objective. Now this is the base, this is the layer 1 which Arjun has understood. Now to go much further, because accounting is not very small, it's vast, it's completely vast. If you want to understand accounts much better, you have to understand all the theoretical concepts very well, because on theory only numbers are made. So now Arjun has a confusion. What is accountancy really? What is studied in the class 11th and 12th? What is bookkeeping and what is accounting? Now I'll say accountancy is a wider term. What do you mean by wider? In accountancy, we have accounting as well as bookkeeping. It is a part of accountancy. Accountancy has a bigger scope. As per the definition, accounting measures only the transaction what happens, which is identifying, measuring, recording and communicating. Whereas accountancy is the whole aspect of accounting. So what we see, that process identifying, measuring and recording, it is the practice of accounting. This comes inside accounting. It is the one part of the accounting. And bookkeeping, again, recording of financial transactions. Bookkeeping involves physical records, where let's say you go to a small business, you will feel that they still record all the sale item, purchase item in the books. They have a, we call it as ledger. If we come to the scope aspect, accounting covers everything from one transaction to hundreds of transactions. That hundreds of transactions completes into statements and users use as interpretations. But accountancy is where the rules, regulations, principle, standard which are used to make accounts. So if you want to get an apple, you have to sow a seed. The seed is the accountancy. The apple is accounting. If you want to get vitamins from the apple, you have to sow the seed. The seed has all the nutrition's value to make an apple. Whereas bookkeeping is only recording of transactions. It's the manual process of doing accounts. If you go to any shop, a small shop near a house, you just go and ask them, are they using computers or not? They will say no, 90%. It's because they want to know how much money they made in a day. It doesn't show in accounting. Accounting shows as a whole everything at the year end. What is the purpose of doing all this? For accounting, it shows to make a financial decision. Of course, it's all in last video. But in accountancy, to make the useful decision, we need to understand the principle and the law or the guidelines to make a financial preparation. So if you want to see a profit and loss statement of a company, you have to understand how a profit and loss account is a maid. For that, you need to understand the principle of accountancy. The principle of accountancy will be seen in the next chapter. We're going to see lots of example like business entity concept or like going concern concept to understand these things. Whereas bookkeeping is only recording of transaction, knowing what money has came and what money has gone up in a day. Focus for accounting is going to be recording and using the statement to make a business further better. Whereas accountancy is a systematic framework for every company. So you might go and find every company has the same amount of balance sheet transaction or the balance sheet items. Your Reliance might even have a liabilities as well as Adani will also have a liability. So it is a common set of principle which every company has to follow, so that a normal people can understand what a company is doing or what a business is doing. But a bookkeeping is just recording the transactions. It doesn't do anything else. Output, which is a financial statement. And in accountancy, you get ledger, accounts, financial reports. Now, financial report doesn't only state your balance sheet or trial balance. You have lots of statements like your reports on your asset quality, your credit rating reports, your compliance reports, and bookkeeping only journal entry. This will be looking into further chapters. And of course, users are going to be your manager, investor, creditor, which we saw in the last session. And same amount of accountancy, we record accounting professionals, auditor who audits your all statements, researchers, whether equity research analyst will plan to invest in a company or not. And here bookkeepers, the owner who will see how much money made in the day, and accountants. Now, this picture is the whole fundamental idea of a business operation. So let's say we have a business transaction. This means you purchase pencil for 5 rupees in exchange of giving money. This is a business transaction where a monetary value and a good or service involves. Capital, where you invest or put money in your business to grow. Drawings, you withdraw money from the business for a personal use. Your liabilities. Liabilities also stated liable. You are very liable to pay the money, the loan, the credit. You purchased your stock in a credit. Credit means you are obliged to pay in future. Your credit means you are liable to pay. You know credit card. Why they say credit card? Credit means you are borrowing money. Asset. This asset will make you generate revenue in future. You bought a machine. This is going to purchase 10,000 rupees, 10,000 worth of units every year. You're going to record that. Expenditure. The purchase of asset is your expenditure. So let's say when you purchase the asset, let's say purchase a machinery, you made an expenditure of installation cost. This is your expenditure. Income. Sale generated from the selling of goods and service. Profit, difference between income and the expense, which is a vice versa of loss, where income is less and expense is more. Purchase, how much you can buy. Selling of goods to the people. Stock, the ownership, the equity of the company. Debtors, you sell the goods to debtor where they own money from you. And creditors is a part of liabilities. Vouchers, it is a supporting documents. So let's say you might got a purchase return or a purchase or sales return. A voucher helps to understand further accounting process. Discounts, so we know what is discounts. Bargaining on price value. So now Arjun has identified a key set of items in his business. So raw material is the inventory. Without raw material, you can't run the business. You can't make patties, you can't make veggies. So you have to buy these things. Stall is an asset. The layers, the metal products which you make. Investment of 10,000 rupees, which his dad gave him. And there are so many fire incident. So he lost few items in that. So it was a loss for him. Stove is an asset because it helps make your food better and gives a good amount of quality. Chef, which he prepares, which he helps to make food, you have to give salary to them. Utensils, again your assets. This is going, without this you can't run the business. A loan of 5,000 rupees he took from his friend to further run grow his business. So now Arjun understood the theme of accounting. Now he knows what he has in a business, what he does in a business. Now further he has to understand how to record everything what happened in his business into books of accounts. He need to understand a lot to how to record the books of accounts. So this is the end of part 2 and this is the end of chapter 1. Hope you liked it. Hope you enjoy the session. Give the feedback how the session was. Give an recommendation how to improve it. That's for the day. Have a great day.